This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we've gone through and looked at all the accounting for financial assets, for financial liabilities, for convertible debentures, and hasn't it been fun? Okay, yeah, a real challenge. I think you will have found that. Hopefully you haven't lost heart and you're still sticking with it. Remember, if there is something on financial instruments, it's not going to be the determinant of whether you pass or fail. Leave it, move on, and come back to it later on. There'll be much easier questions within the exam. Yeah, that's a good opportunity, isn't it, to focus elsewhere and come back to this at the end. However, there's just another bit that we need to consider, because we've looked at everything that's on the financial statement itself in terms of the statement of financial position, the statement of profit or loss, or the comprehensive income with regard to fair value through OCI investments. We've also looked at the reserve transfer that happens when we dispose of those fair value through OCI investments. And because there's a lot going on, the users of the accounts need a little bit more detail to aid their understanding. And that's where we have a separate standard just on the disclosure for your financial instruments. There aren't many separate standards purely about disclosure of an accounting standard, but because financial instruments is so large, so complex, so important to a business, we need to go through there and have additional disclosure. Okay, so we need to know why we have that disclosure there first. Well, effectively it goes through there and gives you more detail about the company's position and the performance. So it will break down all of those investments that you have within the financial statements into their separate components. So you've got all of these investments. The notes will split it out into the investments in debt, the investments in shares, and then whether they are fair value through profit or loss, fair value through other comprehensive income, or measured at amortized cost. Okay, so a little bit like your property, plant and equipment note, it will give you how that balance has moved during the year. But we also need to go through there and look at risk. So we need to look at the nature and the extent of the risks that we are faced with following the financial crisis of 2008, whereby all the banks suffered from a lack of liquidity. We need to highlight to the users how liquid this business is. Okay, so therefore we need some disclosure on the risks that we are faced with, and then also how we are managing those risks. Okay, so what we've got to go through and do then, we're focusing effectively on the financial risk attached to these instruments. So what we've got there is we've got our credit risk. So that is looking at the ability of our customers to be able to go through there and pay the amounts that are due to us. Okay, we also need to look at our liquidity risk. So how effectively we're managing that working capital to ensure that we remain liquid and are able to pay our debts as they fall due. And also looking at the market risk. So if you've made some investments in shares, what is the risk that is attached to those shares? So we can gauge as a user of the financial statements the likelihood of that price going up or going down, and therefore how likely we are to make gains or losses. So when we're looking at the disclosures, they need to be qualitative. So that's the narrative disclosure, and they also need to be quantitative. So that's going through there and looking at the numbers. That's effectively all that you need, but I thought it would be a good idea just to go through and have a look at an example set of financial statements. So I think this is the International Airline Group's notes to do with IFRS 7. Okay, and it's huge. Okay, it's note number 26, so it's scurried away at the back of the financial statements. You can download the financial statements off the internet if you so wish. Yeah, you're looking at me going, who's the IAG group, the International Consolidated Airlines Group? Well, it's the company that is formed as a result of the merger of British Airways and Iberia. Okay, I think they also own, is it a significant stake in Aer Lingus? They also have a low cost airline, is it there, called Vueling or Vueling, however you pronounce it. Uh, I think it's a Spanish airline. My Spanish isn't very good, but to you and I, it's the business that's been formed together by British Airways and Iberia joining together. And I'm not going to go through and read it line by line, but you can see there is that it talks about in the first paragraph how they're subjected to risk. So it talks about market risk. Now, the market risk isn't just any investments that they've got in shares. You know, the big risk that they've got here, fuel price risks, because as that fluctuates, it's going to impact the cost of fuel, ticket prices, and therefore their margins. Foreign currency risk, because if the financial statements are presented in one currency and tickets are sold in another, then you've got that foreign currency transaction risk. There's interest rate risk attached to the borrowings that they have. And then it starts talking about counterparty risk, liquidity risk, and capital risk. Okay. It mentions a little bit there about the management in the second paragraph. So they have some form of two-tier management structure in terms of measuring this risk, led, it seems, by the Treasury Department for the group, but then maybe there is some sub-Treasury Department to do with all the separate parts of the business. It gives us the qualitative and the quantitative disclosures on your fuel price risk. So it talks about what they do with regards to hedging. It starts talking about the impact there numerically on the results. Likewise, you've got it there, is it for your foreign currency risk? We go on to another page there where it starts talking about the strengthening, the weakening of the dollar and the impact that that has had on the results. Starts talking about interest rate risk and again the effect there that the strengthening or the weakening has had on our borrowings. I just imagine reading all this. Counterparty risk that you've got there. Wow, massive, isn't it? Liquidity risk. You know, what page are we on now? Page 140. I think we started way back on page 135. It then starts going through there and analysing all of the liabilities that you've got and when they are due. So looking at giving the user of the accounts a bit more of information about when items are due so they can assess the liquidity of our company and whether or not we think we'll be able to make those payments. Wow. It then starts talking about offsetting. So you are allowed to offset if you have a legal right to offset the financial asset and financial liability, and if you have the intent to offset them on a net basis. So that tends to be why we see a sales tax payable netted off against your sales tax receivable, because we are legally allowed to settle it on a net basis and we intend to settle it on a net basis. Capital management risk. Okay. Oh, blimey heck, it's crazy. And then you can go through there and see the financial instruments. The financial assets split out by category. Okay, this is more along the lines of old IS 39 and the categories there, but you can still see the general idea with regards to how they split out those financial assets for you to get information upon how they have changed or moved during the year. Okay, my word, we're still going. Okay, yeah, fair value of the financial assets and financial liabilities. So it starts talking there about how they have measured that fair value. My word, it's incredible. It really is. Gives you a little bit more about the financial liabilities, fair value. Starts talking about hedging. So that's something you will see in strategic business reporting. I don't know about you, but I'm getting a headache. I'm getting a little bit lost. Giving you huge amounts of information about your cash flows. And then we get into share capital and share premium. There's not too much there. You're probably panicking. Don't panic. That's all that you need to know. Okay. Wow. Yeah, wait till you get into the real world. If you're up for a challenge in the real world and you're there working in audit, then the challenge would be to go through and audit financial instruments and check the disclosure notes. If you don't like the challenge, steer clear of it. It's a fantastic accounting world, the world of financial instruments. But the disclosure for you at this level, that's it. Okay, so don't get too carried away. By all means, pick a company of your choice. Download the most recent financial statements. I think the ones that I had there for IAG were a little bit old in 2015. But get some up-to-date financial statements of a company of your choice and have a look through their disclosure notes for financial instruments under IFRS 7. And don't try and understand them, but just get an idea of what they are trying to do. Okay, there you have it. IFRS 7 disclosures